I'm Richard Stoyeck of stocksatbottom.com, and let's talk about what a stock market crash is and when they've existed and will we see one in the future. The biggest and most famous stock market crash was 1929. And for the most part, it was precipitated by a couple of events, a couple of things happening almost at the same time. One is that there was margin on stock at that time of 10%. Today, if you want to buy a stock on margin, if you don't want to fully pay for it, like you want to buy 1,000 shares of IBM, you tell your broker you want to buy it on margin, and the Federal Reserve requires that you put up 50% of the market price of the stock, whatever it is you owe for the entire 1,000 shares. You put up 50%, and the brokerage firm lends you the other 50%, and you pay interest on the 50% balance for whatever period of time you own the stock. Now that's 50%. It's a half. Back in 1929, the requirement was 10%. So if you bought 1,000 shares of IBM, you put up 10% of the purchase price, and the stock market broker would lend you 90%. Now think about what this means. If the stock declines in price today, and you have 50% margin on that stock today, at some point the brokerage firm is going to ask you to put up additional cash, and that will secure the account. Well, back in 1929, if you had 10% margin requirements and you put up only 10%, if a stock went down 10%, basically your equity was wiped out. If a stock went down 12%, you had negative equity in the account because you only put up 10%. This is what precipitated the financial crisis in 1929, was the 10% margin requirement. Now, of course, you also had the overall problem that the country was starting to go into economic recession, and subsequently it went into economic depression. But these 10% margin requirements precipitated that crash. Now back in 1987, we also had another stock market crash. The market was down several thousand points on the Dow Jones in one day. That big day was 500 points, but the overall decline was something on the order of 2,000 points over a very brief period of time. That's a stock market crash. There were other crashes, but because most of us don't live that long, we don't remember them. There was a crash in 1897 in a panic. There was another panic in 1907. Today, we tend not to have crashes as often as we did back many, many decades ago because there are certain government regulations and movements that control mechanisms that are in place that tend to even out somewhat the cycles, the ups and downs, and the extreme fluctuations that can take place in the economic cycles that we're in. So we tend to be more in balance today. But at the moment, the United States is going into a recession. It's a periodic recession. And in this case, it's due to subprime crisis. So we wanted to cover some of these thoughts with you today. And for more information on this topic, please go to stocksatbottom.com. And thank you for joining us.